What's up everyone, it's Caddy with Money Investing. In this video, I'm going to be talking about one of the best investments out there for investors right now, not just in the US, but globally, there is huge opportunities. So hope you guys enjoyed this video, find it helpful. If you do, please make sure to drop a like. Don't forget to subscribe to the channel. And if you want to get access to a lot more research and analysis and private videos and tutorials, educational content, and a lot of other buy and sell alerts, options alerts, swing trading ideas, a link to our Discord and Patreon is going to be down below. The first week of the month is the best time to join, and we'd love to have you on board. We've got a little bit over 3,600 members in our Discord talking about fundamental and technical analysis all day long. So link's going to be down below. Feel free to check that out. So first things first, we are going to be talking about a very simple linear risk reward curve. This is something that we have gone over in our previous videos, but what you'll notice is that the more risk you take on, the higher the reward is going to be, which is, kind of like markets 101. And you'll notice that the highest things or the highest levels of risk are required by commodities trading, futures, options, swaps, forward contracts, small cap penny stocks, cryptocurrencies. We got hedge funds, high yield markets, emerging markets, IPOs. All these things definitely are farther higher in the risk curve. In other words, if you go higher in the y-axis, that means you're taking on more risk. But if you're also further out in the x-axis, that means the reward is also higher. Now, what is the lowest thing? What is the thing that has the least amount of risk, but also the least amount of reward? That is going to be your government bonds. Yes, the boring bonds that nobody wants to talk about. That is what we're going to discuss in this video. And I'll actually show you guys with math, with my spreadsheets, why and how the government bonds right now can actually be very lucrative. They can actually end up being something that you definitely want to be looking into. I know I am, and I will probably be opening up an account with Treasury Direct very soon, probably in the month of March, and we'll most likely be diving into the government bonds here. And we'll go over, what the thesis really is. But the reason why this is so important right now is because if you take a look at some of the credit ratings, and this is not credit ratings for companies, but instead countries, right? So we're looking at individual countries and the ratings by S&P 500, S&P Global, Moody's, and Fitch. And again, the higher you are in that rating, the more credit worthy you are. It's similar to what you have for your own credit scores, right? So everyone has a credit score because you are using credit. So, that's how creditors and lenders pretty much evaluate your credit worthiness, right? So if you have a higher credit score, that means you are a trustworthy borrower, and you're more likely to get better returns. You're more likely to get better rates, so to speak, and access to a lot of credit. But of course, if you're not so great with handling debt and you're not so great with kind of repayment of your debt, then obviously your rating is going to be much lower, your score is going to be much lower, and as a result, higher return, higher rate, and then of course, you're not going to have as much access to credit. That's pretty much, credit 101, so to speak. So if you go over some of the countries here, and what I've got over here is the yields, bond yields, government bond yields across the world for all countries out there that issue government bonds, right? So first of all, of course, this is alphabetically. So we've got Australia sitting at 3.7%, 3.6, 3.5, 3.6. These are all the yields. These are annualized yields, right? This is how much you would make if you were to buy this bond or T-bill or treasury or whatever it is. If you were to buy this, that's how much you would make per year. These are annualized rates. But you also have to kind of correspond these with how good the country's credit rating is, right? Just because you see a higher yield, it doesn't necessarily mean that it's going to be worth investing in. To give you an example, if you come over to Pakistan, Pakistan's yield right now is over 16, almost 19% for a 3-year treasury or a 3-year bond pretty much. So you can make annualized 19%, but for those of you who don't know, Pakistan is going through a lot of problems from a fiscal budget standpoint. And if you quickly take a look at their credit rating, triple C plus, right? So that is really, really poor. So you want to make sure that you are looking at bond yields that have a higher yield, but at the same time, a very, very strong credit rating at the same time. So if you kind of scroll through some of this list here, again, Nigeria is pretty high, right? 12, 14%. I was looking at that earlier and I was like, okay, let me just take a look at their rating. And we've got, B minus, triple C, C double A, and B minus as well. So not that great. And again, you kind of scroll down the list. Norway has got one of the best credit ratings. So if you come over to Norway over here, you'll notice we've got AAA, AAA, and AAA. However, the yield is lower. So again, you come back to that risk reward linear chart, right, that I just explained. So higher risk, higher reward, lower risk, lower reward. And that is a very good example of how Pakistan, higher risk, higher reward. That's why it's got a higher yield. We've got Norway, lower risk, and we've got a much lower yield at 3.3, 3.2%. So again, if you scroll down the list, Peru 7.6, 8.1%. That's pretty good. Let's take a look at what Peru has for us in terms of that credit rating. We've got triple B, and triple B, so not that great. What we really want to look for is triple A. All things said and done, long story short, I've kind of, literally looked at the entire list, and the best investment out there right now from a credit standpoint ends up being, you guys probably should already know the answer to this, and that is going to be this right here, this little puppy US 6-month bond, or in other words, T-bill, sitting at 5.1374%. This is the highest yield we have right now for a AAA country. And you can see all the treasuries for the United States, not single one of them is sitting at over 5.1%. We've got 4 months sitting at over 5%. We've got the 1 year sitting at just over 5%. We've got the US 6-month T-bill sitting at over 5.374%. And things don't just stop right there, especially if you're watching from outside the US, right? So if you are an investor who's not in the US, you definitely want to keep watching, with some exceptions though. I'll explain what that means. But 5.374%, extremely good yield, because that is pretty much equivalent to what the earnings yield in the S&P 500, the stock market is. So and this is risk-free, right? This is backed by the US government. And if you come over to the United States credit rating, so if you type that in, we've got a AA+, AAA. So one of the best credit ratings you can find out there. United Kingdom has got AA minus. So it has kind of been downgrading a little bit. So if you go over to United Kingdom here, we've got, again, you can see that none of them are over 5%, right? 4.2, 4.1, 3.7. These are called gilts, by the way, and not a single one of them is over 5%. So United States definitely comes out on top, especially this product right here, 6-month yield, 5.1374%. And now let's just do some calculations, right? Let's just see what that's actually going to mean in terms of dollars, because we understand in dollars, right? So let's just do that. So let's just say that you invest $10,000 in a 6-month T-bill, right? So these are annualized rates, by the way. I want to be very clear that this is not like a 6-month rate of return. If that were the case, the economy would be upside down. People would be fighting over this yield, but it's not the case. It's annualized, meaning that you are expected to generate that yield on a 1-year basis. The assumption is that you're going to buy the 6-month yield, it's going to mature, and then you're going to buy it again, and you're going to end up with over 5% rate of return on your principal. So we plug that number in, 5.1374%. And what I've done here is a $10,000 initial investment. And the length of time in years is 2 years. That means, you're just going to keep buying that. And obviously the yield is going to fluctuate, right? It's not going to be the same every time you buy it. But that's the assumption that we're making right now, is that the yields are going to stay higher a little bit. At least for us starters, for beginners, it is going to be, good to make that assumption that, okay, yields are higher. At least take that first step, buy that first 6-month yield, and then we're going to buy it again, depending on where the yields are moving forward. And the compound frequency, we're going to keep it at semi-annually, because again, they're going to mature in 6 months, and we're going to buy it again for another 6 months, so that we are compounding our interest semi-annually every 6 months. We hit calculate, and the number ends up being, in 2 years, it's going to be a little bit over $11,067. That may not seem as much, right? So let's just do some calculation here. And this is going to be that USD return, right? $11,068 to be precise, so rounding up a little bit, $11,068. So your P&L is going to be $1,068, right? That's how much you end up making in 2 years by buying this 6-month T-bill. So your actual rate of return, 10.68%, and your 2-year CAGR, in other words, your annualized rate of return, 5.2%, and that is going to be risk-free, right? No questions asked. There's no risk. Of course, you're going to pay taxes on it, but it's going to be risk-free. There's literally no risk that you're taking on for this 5.2%. And inflation is closer to 6% right now. PCE is a little bit lower, so that is a very, very good rate of return, considering that you're not taking on any risk, right? It's backed by the US government, AAA rating for the United States. Now, if you are watching this video and you are from outside the United States, especially if you are in the Euro area, you're in, the UK area, you're in, in Switzerland, or you're in Japan, or you're in India, depending on where you're watching from, obviously, currencies are going to matter. And I will show you how the real return, the currency adjusted return, is going to be much higher than 5%. Okay, and it's also going to apply to people that are maybe in the US but have families maybe outside of US, or if you are interested in maybe, spending money outside the US eventually, it's definitely going to be beneficial to you to understand how these dynamics work from a currency adjusted standpoint. It's really, really important stuff. It's actually quite interesting stuff. So it'll be a little bit educational slash a little bit of a tip or analysis for you. So what I've done over here is I've taken the 1 USD, which is the United States dollar, 1 US dollar, and I've compared it to the 7 other currencies, which is going to be your INR. So that's going to be your Indian rupees. We've got euros, right? So Europe, and we got Great Britain pound, sterling, right? In the UK. We've got Australian dollars, we got Japanese yens, we got Canadian dollars, and we got the Swiss francs. So these are the 7 currencies that I've taken into account, and I will show you with the 6-month T-bill what your currency adjusted return is going to look like. It's going to absolutely blow your mind. So with INR, so let's say, for example, if I decide today that I wanted to invest in the 6-month T-bill, right? And I wanted to put in, let's say, $10,000, what will happen? Well, in 1995, right, 1 USD was worth around 31.4 INR, right, Indian rupees. But over time, the United States dollar has appreciated against the rupee, right? So in other words, the INR, Indian rupee, has depreciated in value. So it's gone from 31.4 to 81.7. And yes, foreign exchange, I understand it can really, screw with your head. But in this example, even though INR is increasing, it is depreciating against the US dollar, right? Because it's taking more INR, it's taking more rupees to buy the same amount of $1, right? So it's gone from 31.4 to 81.7. That is a compounded annual growth rate of 3.47%. What does that mean? That simply means that every single year for the last, 28 years, from 1995 to 2023, for the last 28 years, the Indian rupee has depreciated against the US dollar by 3.47%. Okay, that's why it says depreciated over here. Now, if I simply take this analysis here, that every year INR is going to depreciate by 3.47%, and I decide to invest in the 6-month T-bill, what is going to be my currency adjusted rate of return? Let's just calculate that. So let's just say that INR, I invest $10,000. As of today's prices, which INR is sitting at 81.71, I will be putting in 817,000 rupees, right? That's going to be that number right there. In 2 years from now, when I have made over 1,068 US dollars, right? That's going to translate to over 968,000 rupees. This is adjusting for the currency depreciation, because the assumption is that over the next 2 years, INR is going to depreciate against the US dollar, right? Because it has been over the last 28 years. So making that assumption that over the next 2 years also, it's going to depreciate by 3.5% per year. So this is going to be my 2025 account balance. This is how much I invested. So my P&L is going to be 151,000 INR, Indian rupees. So my actual rate of return, currency adjusted, is going to be not 10.6%, but it's going to be 18.5%. And annualized, that is going to be over 8.86% risk-free. So that is the power of not only taking advantage of a higher yield, but it's also taking advantage of the currency depreciation, right? So USD appreciating against the INR, that is the power of taking advantage of both the currency hedge and as well as the treasury, the T-bill hedge. So if you compare this to other currencies, now it's not all going to be playing out exactly like Indian rupees, because INR has depreciated against the US dollar the most, as you can see, 3.47%. And maybe, your currency is a little bit different. It has appreciated, depreciated. You have to do that analysis for yourself. But of course, Australian dollar, Australian economy doing really well. And since 1995 till now, they have actually appreciated against the US dollar, right? By 0.3% every single year. So they've actually done really well. Same thing with Canadian dollar, right? It's been pretty much flat, so it hasn't really moved much since 1995. And Swiss francs have really appreciated since 1995, when 1 USD was about 1.15 Swiss francs. Now they're under 1. So, Swiss francs are more powerful. In other words, it's a stronger currency against the US dollar. So your of course, your returns are going to be a little bit lower investing in the 6-month T-bill. So these are all the example numbers here that I've taken into account. So for example, if you end up investing in, let's say, 9,400 euros in this 6-month T-bill, in 2 years from now, you're going to have 10,543 euros. Your P&L is going to be a little bit over 1,100 euros, and your total rate of return is going to be over 12% over 2 years, and your annualized rate of return is going to be almost 6%. And again, that's risk-free, right? Because you're investing in the U.S. credit, U.S. debt markets, which are backed by the U.S. government. So there's little to no risk involved with that T-bill, right? That's one of the safest bets that anyone can make. That's why it's called a risk-free rate. So again, this is the analysis that I've done. You can kind of see for yourself which currency is best, for you. And again, obviously not all of them are going to have a higher rate of return. So even in the US, like 5.2% may not seem like a great return to a lot of people and be like, hey, I mean, this is not that great for me. So you have to do that analysis for yourself, but think about it. You're not taking on any risk, and you're kind of like in balance with inflation right now, considering a lot of uncertainty. And these yields could even go higher with the way they're moving right now. They could easily push a little bit higher here. I mean, 6 months from now, we could even see 5.5%, 6% for the 6-month yield. And I can tell you that a lot of people are thinking about it. Some of the big banks are already betting on this to take advantage of that 6-month T-bill as high as it's already gone. There are some assumptions that I'm making, so I'm going to have to go over that as well, because it's important for me to kind of go over the analysis and the assumptions that I'm making. Number one, USD appreciates against your currency. Not every currency has depreciated against the US dollar. In fact, as I mentioned, the Australian dollar, the Canadian dollar, and Swiss francs have all appreciated against the US dollar since 1995. So their returns are going to be a little bit lower. So for example, Swiss franc, you can see 4.45% as opposed to USD denominated 5.2%. And then if you take a look at Canadian, it's going to be pretty much equivalent to what the USD rate is. And then Australian dollar is going to be 4.89%. So a little bit lower than what the USD is. But, you can also choose to invest in Australian dollar. You will get that currency hedge because Australian dollar is appreciating against the USD. But at the same time, the Australian dollars, as we looked at earlier, the bond yields are not super high, right? They're as much as 4.2% the 30-year. But then you're also locked for 30 years until maturity, right? So 6 month or even 1 year is 3.7%. We've got, there's no 6 months apparently. So 1 year is the lowest yielding at 3.76%. Obviously a lot lower than 5.17, 5.2% as offered by the 6-month T-bill in the United States. And then of course we got Swiss francs sitting at 4.45, but all the other ones, euro, almost 6% risk-free rate, pound, 6.18%. We got INR at over 8.8%. This is that I would absolutely be doing this. Like, this is like a no-brainer for me. And then we've got yen, Japanese yen sitting at almost 7% if you were to be investing in the 6-month T-bill. So let me know your thoughts on this. Let me know what you think about this. Again, I put in a lot of research analysis into this. It's a very, very interesting analysis, of course, from a standpoint on how it's like a risk-free rate paying you 6-month T-bill at over 5.2%. And then, of course, if you have that currency hedge, you can, your currency adjusted return is going to even be higher than what the 6-month yield gives you. So I hope you guys enjoyed this video, found it helpful. I will be sending out some alerts if I, invest in these bonds. We'll be opening up an account. I've already reached out to Treasury Direct. So just need to get some requirements, paperwork, and documents done. And then we'll be definitely on my way to investing in the bond market. So I hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe, hit that notification bell, and the link to our Discord Patreon is going to be down below if you're interested in joining us. As always, happy investing, and I'll see you all in the next video.